CNBC put out this pretty scary article talking about millennials and retirement. What this said was the vast majority of millennials want to retire by the age of 65. No surprise there. But if you want to retire by 65 and you want to be able to live off of just half of your final career salary, then you need to be saving, if you're a millennial, not 10% of your income, not 15% of your income, not 25% of your income, but about half of your income for the next 30 years. Retirement is a really weird concept. Personally, I hate the whole idea of traditional retirement where you work from the age of 21 until 65 or 67, and then once you hit that age, then you can quit your job finally and then do nothing until you die. Well, I guess some people look at retirement as the time when they'll finally be able to travel and finally be able to go enjoy the world and enjoy their lives. But why do you want to start enjoying your life when you're old? This is one of the reasons why people say those who retire early die early, because when you're sitting in retirement with nothing to do except watching reruns on TV all day, every day, you feel like you have no purpose. I would much rather like to see you change the whole idea of retirement from working this job that you hate for 45 years so you can ultimately quit and do nothing, to doing something that you love, and then when you hit retirement or financial freedom, that now you can kind of scale back while continuing to do what you love while spending more time traveling and spending more time with your family. If all you know is your job and this is what you're looking forward to day after day after day, then when you hit retirement, it is going to be a very sad day, because then you're not going to be able to go back to your job and you're going to feel like you have nothing to do. Like, there was an uncle of mine who used to be an engineer, and he worked this engineering position for decades. And as soon as he retired, he immediately started having all these health problems because he was doing nothing except sitting on his sofa and watching TV all day long. And so he went from this healthy person to immediately becoming this old person, like almost overnight, because he started having so many physical health problems. He went into depression, and it created all these problems just because he hit retirement and had nothing to do. Now, while that issue is kind of like, what do you do in retirement and how do you live your life? The second issue is the financial side of the issue, because CNBC has made it clear that millennials are financially screwed when it comes to retirement. Well, at least the people that don't understand money, that is. The whole idea of retirement, strictly financially speaking, is you can now live life the way you want without having to worry about money, because you have built up this nest egg, these savings or this investment or whatever. This income or this nest egg that you have created will now be able to fund your life. That way you can live your life without having to go to a job in order to get paid. Previous generations never really had to stress too much about retirement, because if you followed the system where you went to school and you got a good job and you put in your time at your job, then you were pretty much guaranteed a pension or social security or both, so you could be able to live your life and retire kind of without really that much stress. With millennials, it's a little bit different, because now you got to plan for your own retirement, and if you don't start doing this early, you're gonna pay the price later on, and that's what I'm gonna be talking about in this video. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below. So if we go back to the CNBC article, this article is based off of research from an MIT economist, which says that millennials want to retire by the age of 65. It says that a third of millennials want to retire between the ages of 65 and 69, and another 43% of millennials want to retire before 65. So you have the vast majority of millennials that want to retire at 65 or earlier. Now, you have all these millennials that want to retire at 65, but when it comes to actually planning for retirement and putting money aside for retirement, only half of millennials are putting aside more than 6% of their income into something like a 401k or any investment to help actually fund their retirement. And only 1 in 5 millennials are saving or putting aside more than 15% of their income to actually fund their retirement. But it gets a little bit worse. So what this is saying is that 3 out of 4 millennials want to retire by the age of 65. A lot of these people want to retire before the age of 65. But now, half of millennials, about 50% of millennials, are saving or putting aside 6% of their income max. So this is like the maximum amount of money they're putting into the 401k, while only 20% of millennials are putting aside 15% of their money or more into the 401k. So this other 30% is saving somewhere between 6 and 15%. So you have the vast majority of millennials who want to retire at 65, but now the vast majority of millennials are also saving or putting aside less than 15% of their income. Now, when I say saving, I don't mean putting this money into a savings account. I mean putting this money aside for your retirement into something like a 401k or your other investment accounts. 80% of millennials have less than 15% of their paychecks going towards their retirement accounts. And this article says that if millennials want to be able to retire, you got to be saving 40% of your income for the next 30 years to be able to live a retirement where you're living a lifestyle where you're just pulling out half of your final salary before you hit retirement. Now, the reason the economists are saying that this money that you're putting aside towards retirement isn't enough is because they predict that the stock market where this money is going, right? When you put your money in the 401k, it's going into the stock market. They think the stock market is not going to grow as fast as it used to. They say that in the past, the stock market used to grow by an average of 10% a year, but in the future, they expect it to grow somewhere between 3 to 5% a year. Some companies like Vanguard actually predict that it will be below 2% a year for the next decade. That's concerning because if over the next couple of decades, when people are trying to build their wealth, you only see your money grow by 2 to 3% a year on average, then you're not going to be able to build the wealth that people were able to do in the past, because in the past, people saw their money grow by 7, 8, 9, 10% a year on average. And so that can affect how fast your money compounds, because when it comes to compounding your money and building wealth, there's 3 factors you got to look at. You got to look at how much time your money is invested for, you got to look at how much money is invested, and then you got to look at the interest rate. You cannot really change too much about the time unless you start earlier, but you cannot change the past. So the next best thing you can do is start investing your money today. When it comes to how much money you can invest, obviously you can try to invest more money, but it can be hard for some people to invest half of every dollar that they earn. And the third thing we can look at is how fast your money can grow. And if what they're saying is true, where money's not going to be able to grow as fast, then that's going to hurt a lot of people when it comes to building long-term wealth. Let's take a look at it. Let's assume that you are making $50,000 a year. And for the sake of this example, I'm going to assume that there's no inflation in this world. So you are going to make $50,000 a year every single year until it comes time for you to retire. And I'm going to assume that you are investing 15% of every dollar you earn before taxes. So 15% of $50,000 means you are investing $7,500 a year. If you can do this, and you do this for the next 30 years, well, over those next 30 years, assuming you get a 2% annual return on your money, then your money is going to grow to $323,000. If you can get a 3% annual return on your money, then your money is going to grow to right around $380,000 when it comes time for you to retire. Now, the problem here is if you want to live off of $50,000 because this is what you're used to, this is what you've been making every single year, then even if you make 3% a year on your money, then this money is going to last you less than 8 years when it comes time to retirement. So if you retire at 65, you're going to be broke by the time you're 75. And even if you're living off of just half of what you made as a salary, so if you're living off of $25,000 a year, you're still not going to get 20 years worth of income from this money, assuming you don't keep investing your money when it comes time to retire because you move your money into something safer like bonds where you're getting even lower returns. If that's the case, then this money is not going to take you to 85 years old. You're going to be broke in your golden years of retirement. If what these economists say is true, that millennials are only going to see a 2 to 3% return on their money over the next few decades, then this is very, very, very bad news for millennials, especially because only 1 in 5 millennials are putting aside 15% or more for retirement, while the vast majority of millennials are doing way less than that. Now, if you are a millennial and you're watching this, there are things that you can do. That way you can get better returns on your money. And I'm going to get to that in just a second. But the reason why these economists and these financial institutions are kind of predicting these lower returns in the future is because they think that our United States economy has grown so big that we're not going to be able to grow as fast. You can kind of think of our United States economy like a company, because when a company is small and is in the startup phase, it can grow a whole lot faster than it can once it becomes mature and bigger and older. Like if we look at Amazon, for example, in the first decade that Amazon was in existence, they were growing by 100% a year. But now that they're so big, you're not going to see them grow by 100% a year every single year over the next decade because they're so large. There's not that much market share that they can grow by that quickly. So the bigger you are, the harder it is for you to grow as fast. That's why when you invest your money into blue chip stock, like a bigger company, something like McDonald's, you're not going to expect to see your money double overnight, versus if you invest your money into a startup like maybe Tesla or Peloton, you can see your money grow a whole lot faster because these companies have the ability to grow a lot faster because a lot of people are not buying or using their product yet. And so they have a whole lot more market share that they can take, and so they can grow very quickly. So the smaller you are, the more potential you have to grow faster. If you look at the United States economy back before the 2000s, you would see our GDP, our economy, grow by 5, 6, 7% a year. But now we are happy when we see our economy grow by just 2% a year because our United States economy has become so large. I mean, we are a massive economic superpower. And when you become that big, it becomes so much more difficult to maintain that same rate of growth that you saw before. And so in order to keep growing quicker, you might have to take on more risk. So the whole idea is because our economic system and our economy is so big now, we can't grow as fast as we once did because our economy is already so large. And so we kind of have to expect smaller returns. But just because that's the case for the overall economy doesn't mean that you have to accept these smaller returns, because there's other things that you can do with your money to kind of balance this out and get better returns for yourself. Now look, I gotta give you a little bit of a disclaimer here because investing has risks. You are never guaranteed to make money when you invest. You might even lose money, which is why you gotta always do your own due diligence and never blindly listen to a random guy on YouTube. In general, higher risk comes with higher potential return. So what you want to figure out is how you can get this higher potential return while kind of mitigating your risk. One way that you can mitigate this risk is by learning and finding alternative investments that can get you better returns, and because you learn and know how to do this, you can lower the risk while getting the higher returns. One thing that we're going to see over the next decade is cheap money. I mean, we have interest rates that hit rock bottom in 2020 and 2021, and they're going to stay low for a long time, and so we have this huge influx of money into our economic system, and this money has to go somewhere. One of the places this money can go is into startup companies, and so startup companies can borrow money very inexpensively and use this to start and grow companies. There's a couple different ways that you can invest in these innovative and growth companies. You can go out and find the individual companies to invest in. So you can go out and find these startups and you can do the research on them and you can study their financials and you can see who is a good person to invest in, who is a good CEO, who has a good executive team. And when you find a company that you like, you can invest your money into it. But then you also got to do the upkeep. You got to listen to the earnings calls. You got to see how much money they're making. You got to see how they're innovating, because you want to make sure that your money is in a good place. I don't recommend this for the majority of people because this takes a lot of work and a lot of time. And if you're not willing to put in that work, then you are taking on all the risk without mitigating it. Because when you're investing in startup companies and these innovative companies, there's a high chance that these companies can fail because it also comes with more risk. The alternative is you can invest in an ETF, which is a fund that gives you exposure to a bunch of different companies. So there are ETFs out there that gives you exposure to growth companies and innovation companies. So these are ETFs that give you exposure to a whole bunch of different companies, a whole bunch of different stocks. So if one company in your fund goes down, then you're okay because this fund will have a whole bunch of other companies, but you're getting exposure to a general group of stocks. So there are ETFs that give you exposure to growth like VUG. This is a Vanguard fund. And there's innovation ETFs like ARK. Again, these are just examples. I'm not telling you what to invest in, but I do got to let you know that I do have some of my own personal money in this ARK fund. But these are funds that you can invest in that will give you exposure to growth companies up here or innovation companies over here. ETFs work just like stocks. You can buy and sell shares of these ETFs right on your stock brokerage. And if you go and do a little bit of research, so do a Google search on either of these ETFs, you'll see what companies they invest in and what their investment goals are. The thing that you have to understand when it comes to investing your money in ETFs is your goal here is long-term growth, because ETFs are not things that you should be day trading. These are things that you want to be investing your money in for the long term because you believe in the companies that these funds are investing in. So you believe in innovation and you believe in growth and you like the companies that these funds are investing in, and so you want to own a piece of that fund to have you get exposure to these companies. And the key for this to work is you got to keep consistently investing some of your money. I say at least 15% of your income every time you get paid into these funds, and this is something you got to be doing for years, right? Because we're talking about building this financial freedom, and so the goal here is not to see your money go up in a month, is to see your money grow consistently over the years. The third way that you can beat the returns of a slowing stock market is by investing your money in real estate. But there's a few different ways that you can invest your money in real estate. One way is through REITs, R-E-I-T. I'll explain what that is in just a second. Another way is through crowd-funded real estate. And the third way is through rental properties. I gotta get me a new black marker. REITs stand for Real Estate Investment Trusts, and these are things that trade on the stock market. Now, when you invest in a REIT, you're not investing in an actual property, you're investing in a company that invests in real estate. So you can invest in REITs that invest in apartment complexes, you can invest in REITs that invest in strip plazas and commercial buildings. There are REITs for all different types of real estate. The interesting thing about REITs is that REITs are required by law to pay out 90% of their taxable income, so the rental profits, to the shareholders, people like you, through dividends. And so many times you're going to see REITs that are paying out dividends more than 3% a year. This is in addition to stock price appreciation, which you're hopefully going to get. So when you buy shares of a REIT, you're going to hope that the price of your shares go up. But in addition to that, every 3 months or whenever they pay out a dividend, you are going to make this passive income. Crowdfunded real estate is a little bit different. This is a way for you to get exposure to physical real estate without having to buy an actual property yourself. So what you're doing here is you're investing your money into a fund. This is not something you do on the stock market. You got to use a crowdfunding service. I'll have articles and resources for you in the description below if you want to learn more about how to do that. But you're investing your money into this fund, which gives you exposure to physical real estate. So you might be investing in a fund that gives you exposure to prime-time apartment complexes in Miami, or it gives you exposure to prime-time developments in LA. Essentially, you're investing your money into something that gives you the same returns that a physical property is giving you. The advantage of this is now you will get appreciation and dividends from your rental income. And you don't got to worry about dealing with tenants or finding properties or dealing with property managers. You're just investing your money into a fund. The third way that you can grow your money faster is by investing your money into rental properties, especially value add rental properties. So this is my favorite place to invest my money. When you invest your money into a rental property, you're going to buy a physical property, let's say a house. And once you own this property, you can lease this property out to somebody else, so a family can live in your house, and every single month they're going to have to pay you rent for living in your property. So not only are you getting passive income, but if housing prices go up and real estate prices go up, your property values are going to go up as well. Now, to put this in perspective, if you invest your money into a REIT, typically you're going to see dividends paying you somewhere between 2 and 10% return a year. The higher the dividends, the higher risk, but these are pretty standard when it comes to REITs. So somewhere in the 2 to 10% a year, and this is consistent passive income you're gonna get for just investing your money into a REIT. When you invest your money into crowdfunded real estate, you're typically gonna see somewhere between 6 to 9% a year. At least this is what I've been seeing in the past, and I have some of my money in crowdfunded real estate, and these are the type of returns that I've been seeing. And when it comes to rental properties, this is really going to depend on which area you're in. But if you're in a big city, you're going to see lower returns. If you're in somewhere like the Midwest, then you can see much better returns. Me, personally, I'm looking for something between 7 and 8% cash flow a year. The reason I like this is because this number typically goes up over time because rental prices go up, and so you make more money and you own something physical and tangible. Plus, when you own physical real estate, you also get tax breaks because the United States tax code gives a lot of loopholes to real estate investors. Now, I know this is not easy. This is more work. This is going to require effort on your part to learn how this works and actually put in some time and some money to invest here. And yeah, you're going to go through a learning curve. There might be times where you lose money. I even talked about my worst real estate deal ever on YouTube. There are times where you will lose money, but these are things you got to go through if you want to be willing to get the higher returns. That way you can actually build your wealth. Because if what these people say is true, and you're only going to see 2 to 3% returns over the next decade or decades on average, then it's going to be much harder for you to build your wealth. And so this is where you got to really break away from the majority of people. I mean, that is why we call ourselves the minority mindset, where now you are taking care of yourself and your finances, because you do not want to run into a situation where you have to rely on someone else like the government. That way you can be able to live your life. This is where financial education is so important, because most of us are never taught about the different ways that we can grow our money. We're just taught to go to work and invest our money in our 401k. But if that's not working, or if it doesn't work in the future, you gotta know how to start planning your money today. That way you can live the life you want when you want. We are in the calm before the recession storm. At least that's according to Jamie Dimon, who is the CEO at JP Morgan Chase Bank. Every year, JP Morgan puts out their own annual statement where they talk about their opinions of what's going on in the economy, their worries about the economy, what they think is coming in the economy, and then Jamie Dimon also